2025, what a year it's been. And for each of these firms, respectively, Coinbase, FalconX, CM Group, and Hidden Road, big years for all of you. And we're going to dive into a little bit more about what we're seeing in the industry and where things are moving forward. Usman, I would love to start with you because looking back 5 years ago, the term institutional was maybe kind of slightly adventurous asset managers, and that was kind of the extent of what we saw as institutional demand in crypto. But now we've got sovereign wealth funds. The demand is just expanding beyond most of our imaginations. How are the strategies in Coinbase at the moment, and can you share a little bit more about the narratives in 2025?
Yeah, so a few years ago, like you said, it was always a side project of a niche team to venture into crypto. They started off with basis trading, which is what they understood in TradFi. We've come a long way. As you said, we've got sovereign wealth funds, corporates, governments, asset managers. They've all ventured in their own way into crypto. And the sequence of events in my head has always been like they started off with basis, which they understood. Then the macro funds started thinking, hold on, there's a deep pool of liquidity here that I can access outside of traditional market hours. And then they started using crypto as a release valve for geopolitical macro events over the weekends. That created a bit of a FOMO with asset managers where they're like, they have to be involved in order to stay competitive. That deepened liquidity further and also grew demand for stable coins, which are the backbone of everything that happens on crypto. Then the asset managers, corporates started seeing this growth in stable coins and started saying, actually, this is a great way to efficiently manage my treasury. And they started doing, whether it be internal treasury management or accepting payments with blockchain. And that's suddenly evolved to, all corporates doing that, accepting payments, cross-border payments. And then now we get asset managers that are looking at doing further yield enhancement and are also going into DeFi and, doing liquidity provisioning, lending, the whole works. So completely different position to be in than 5 years ago.
Completely different landscape, and the opportunities are endless. You've mentioned stablecoins there and just the opportunities that they bring to our industry. And Joshua, I'd love to turn to you now because you've also referenced that USDE and other stablecoins are this native internet money, and we're seeing stablecoins move beyond what we see as just settlement into collateral and different settlement tools, but also, as you've mentioned, DeFi narratives too. So what kind of client behaviors are you seeing specifically within stablecoins at the moment?
Yeah, absolutely. Stablecoins are maybe just one of a broader category of yield-bearing assets that investors can hold on-chain and can put to much more productive use than just holding cash in a bank account, right? I think we live in a world where as interest rates have come down, people are looking for higher sources of yield, even going further on the risk spectrum. And in particular, in the world that most of us operate in, as counterparties, trading counterparties to hedge funds and venture firms and asset managers, they're all looking to trade on bilaterally, like with a dealer like us, FalconX, and use these assets on chain as collateral, as you mentioned. Generally speaking, historically, like looking back 5 years ago, the most common assets were just things like Bitcoin, ETH, USDT, USDC, generally assets that don't carry any interest. And it was very capitally inefficient for people to hold these assets without accruing like the natural yield, maybe in the protocol yield embedded in the asset, or for dollars getting that interest rate that comes from, even just from T-bills, right? So what we're seeing more and more are people using things like USDE, which carries a yield from the basis trade, really from all of the leverage speculators in crypto who are, using perps for leverage effectively, and that's kind of where the yield comes from, or even just the more traditional kind of T-bills backed stablecoins. And they're posting that to dealers like us. There's numerous advantages, one of which is the capital efficiency and the yield, but another is just being able to settle margin calls over weekends, right? That's something that in TradFi has been a difficult, proposition for, settlement networks and prime brokers and all the kind of existing infrastructure to deal with. And so it's unlocking like a lot of new opportunities. And one more area I'll just mention briefly is Athena kind of, with USDE, opened up a door for other actively managed delta neutral type strategies. Not all of them can properly be called stablecoins, but they're certainly kind of dollar pegged or kind of stable value type strategies that are mostly generating yield on chain and packaged in a tokenized format that can be used and carried portably across different strategies or as collateral anywhere, really, on chain and off.
Fantastic, thank you. And Giovanni, I'm curious to hear from you now, because I think we can all agree CME Group has been really central in legitimizing crypto and the digital asset space and the crypto markets. Interestingly enough, you're now moving into Solana, XRP futures as well. So I'm curious to hear, when it comes to institutional clients, what kind of demand are you seeing, and what kind of trends and signals that we're really ready to move away from just Bitcoin and Ethereum futures for the institutional market?
Oh, thank you for that question, Jessica. And I think, firstly, it's really the undeniable success that we've seen with our regulated cash-settled Bitcoin and Ether futures, which have grown to trade now over $13 billion per day. That really indicated to us that there's growing demand for other cryptocurrencies beyond, or futures on other cryptocurrencies beyond, say, Bitcoin and Ether. We also saw a very strong client demand with Solana actually being the most requested product beyond, say, Bitcoin and Ether. So really indicating that clients were looking for diversification beyond those two main coins. And I think when you look at the market cap of Bitcoin, Ether, XRP, and Solana consistently rank behind Bitcoin and Ether, so indicating that there's robust liquidity there. And I guess lastly, really greater, say, regulatory guidelines giving us that comfort to launch these additional products. And the launch has been tremendously successful. In fact, the launch of our Solana and XRP futures have been the fastest growing products for the exchange. We, since Solana launched on March this year and XRP in May, we've traded more than $50 billion across the suite. We've also seen tremendous growth in terms of open interest, with XRP actually hitting the 1 billion mark in just about 30 days, right? It took Bitcoin 3 years to achieve that feat. And not to be undone, Solana crossed 1 billion mark in open interest the same day that XRP did, but it quickly went to double in open interest in just 18 days. It took Bitcoin a little bit over a month to do that, and Ether, which is a little bit more akin to Solana, took 3 years to achieve that feat. So we're really seeing institutions looking, say, for the deep liquidity, the trust of a regulated exchange brings.
Great, thank you. And Joshua, now over to you, because 2025 has been a huge year for Hidden Road. So I'm curious to hear from you now when it comes to what we're seeing with new forms of collateral emerging for different clients across the institutional board. What kind of trends are you specifically seeing? And also, how is your role with clients changing?
Sure. I'll piggyback a little bit off what Josh said, because he covered a number of the new popular forms of collateral, but I'll try to do it through the lens of a prime broker. And so there's a number of factors that you need to consider when accepting collateral. The first one being, do you understand the collateral and the liquidity profile to that? And do you stress that? And if you needed to default it, how do you get your dollars back? So it's a very important first side of it. The second side of it is really more around how counterparties post the collateral to you. There's generally two options to that. First is under title transfer, where they'll post those assets that sit on your balance sheet. The second is, and institutions will want this and already are demanding it, is to post those assets in tri-party. And so meaning they hold those assets away, and so you need to understand the account control agreement, how you get access under certain situations. So that's just like general type of collateral. In terms of like what collateral we're getting, a lot of people still want to trade the Bitcoin basis trade. Bitcoin is a non-carry asset, and so being able to post that as good collateral and have somebody like Hidden Road finance dollars to perhaps run a Bitcoin basis trade where I think we're still the only FCM that takes Bitcoin and will finance dollars to cover span margining. In that setup, you need to understand not only and model the basis risk, but understand what that Bitcoin as collateral is. Playing on that, it's XRP, it's Solana. Moreover, you're starting to see that in securities. Everybody's been buying ETFs, and now you have security law interest introduced, but they're long ETFs, short front month CME future. Again, the liquidity side is really important. Josh briefly mentioned it, but I think it's really important that as large institutions come into this space, the quantums of collateral that they pose will dwarf where we are now. It is critical that you have assets that pay positive carry for that, and those need to be digital. And so this is certainly, tokenized money market funds, the early stages of, BlackRock and, V-Bill. There's a number of those, a number of more of the yield-bearing stable coins, Guy and Athena, Ondo Finance, like the list goes on. There's several. Each one of those have different liquidity profile, lockup periods that you need to properly understand. So thematically, from a prime perspective, these types of assets that you can tokenize value and ship those around 24/7 changes the risk management. So from my standpoint, it shrinks what we call our MPOR, which is your margin period of risk. Clients can meet collateral calls more efficiently, and so that just naturally makes markets more efficient. I'd end with this of kind of where we are. It's still early on, but last week, CFTC Commissioner Pham came out and formally announced tokenized collateral in the stablecoin initiative. That, to me, is the first step for regulated markets to start to move 24/7, where you can have collateral, again, early on, but exciting developments.
Certainly. And now we're going to open the floor for everyone to answer. First question, I think everyone in the audience will agree when looking at the crypto markets, it's follow the money, follow where the institutions are moving. And institutional inflows, undeniably, we've seen 2025 has been a very significant year. So I'm curious to ask all of you, when it comes to institutional inflows that we are seeing, deeper liquidity into the markets, are we going to see capital rotations flow through this, or is this a risk that we're seeing concentrated activity within the crypto asset classes? Usman, maybe we can start with you here.
Sure. I think a year or two ago there was concern that with the launch of ETFs we're going to have bifurcated liquidity, where as IBIT and other providers grow, those assets stay in TradFi and can't flow down into crypto. I think we've seen some of that shift, and DATs have really helped, where the managers of the DATs essentially have to do something with the assets that they purchase, and that activity is flowing down into the crypto economy, whether it be via DeFi, lending, or going further down the stack of crypto assets. So I think we're definitely going to see some spillover. I think we already have. I just think that it's going to be a multi-step process. But ultimately, as Mike and Josh and Giovanni have said, that once we unlock institutional capital, I think we don't really fathom just how big the institutional capital is, or the TradFi capital coming into crypto.
Absolutely. Josh, I think.
Yeah, I agree. I mean, I think we at FalconX have been pretty active in the digital asset treasury trade, both as an investor and as a facilitator, execution partner, custody and staking partner for a lot of these treasuries. And I think it does mark like a very significant milestone for our asset class, that these assets that had previously been pretty dispersed across a lot of early adopters, high net worth people, retail holders, are now being reconcentrated and sort of accessible to a lot of the folks in the institutional category like us, in these sort of vehicles that are professionally managed. So it does really change like the character of the industry and how these assets are getting deployed. For us, it's important because we're then now talking to investors, professional investors that are very familiar with derivative strategies, generating yield. They can properly assess the risk reward of deploying assets into a protocol, for instance. You have very savvy investors like Kyle Samani and the Solana DAT, who has already come out and said that they're going to deploy a lot of the Solana assets in yield-bearing strategies on chain. in the Solana ecosystem. So it's a huge milestone, and it really will drive a lot of value creation for protocols on chain that are specifically built to serve that professional investor category. So if they're maybe we kind of hate to see this in the crypto native world, but probably things like permissioned and KYC things, things that are a little bit less levered, a little bit less degen, but maybe more regulated in a way, will probably gain a lot of traction. And those are really like the protocols that we're investing into as a firm. Strategically, we think there's going to be a lot of growth in TVL, in those types of things that cater towards treasury and CFO type personas.
Yeah, and I think when you look, say, at what institutions bring, right, we're seeing sort of like a deepening of that liquidity, right? If you look at just how the evolution of, when we first launched Bitcoin futures in December 2017, who the personas were then, right? It was your traditional liquidity providers. We started attracting some of the crypto natives, some of the crypto focused funds, but to the point that some of my fellow panelists made, that basis trade was something that was being traded, but it was limited, right? So it was those funds that had access to, say, the spot markets that were putting on that trade. But it really wasn't until the introduction of the spot ETFs last year where we now started seeing additional market participants come into the space. So now you started seeing some more of the traditional hedge funds enter the space, and a lot of those hedge funds entered to put on that basis trade. But as the year went on, we started seeing hedge funds now taking a more tactical approach and more directional plays as well, which has been something that a trend that I think will continue. So we do see as more of these participants come in, you see greater volume, you see deeper open interest, and it really just all builds where you start seeing momentum and greater numbers overall.
Best for last, I guess. Yeah, I think it has a lot to do with what my colleague said, right? Is the type of products, and so that's have been clear. But in terms of concentration risk, there's about 100 billion in those. 93 billion of it is in Bitcoin, just shy of 7 billion is ETH, and there's a tail of up to 10. So you're still absolutely seeing concentration there. But in the Bitcoin and ETH world, where you're starting to see very large options market, like the IBIT options when it first started was 73,000 contracts traded in the first 60 minutes. It's now bigger than some of the larger crypto native options venue in a very short amount of time. So I think why options are important, it dampens the downside risk, and that institutions can come into those. But staying a little bit on the crypto native side of institutions coming in, because you're now getting proper certainty and clarity from the regulators. And so you can book it in the US and pay taxes. FASB came out and codified. These things are all moving in that direction. And so what I see from our side is a little bit from a trading standpoint is like the large statistical ARB guys that were pretty famous in small cap, mid cap equities, applying similar strategies and techniques into digital assets, and they're trading across a surface of coins that's 150 to 200 names and getting sufficient liquidity off. And so I think that's the growing market. Not everybody's delta neutral, they're stat arbish. And so for us, that's an exciting development, and I think those types of institutions can deploy material capital. As for new coins coming up without a perk market, super limited. So exciting times, but still heavy concentration in the main products.
Maybe just to add a little bit to that, right? Because you're absolutely right. I think when you see the growth in the markets, right, it is allowing, say, for some of those more sophisticated strategies, some tried and tested protocols, for example, that have been deployed across other asset classes, and we're beginning to see that. We're also beginning to see interest, and to your point, Mike, on options where institutions have really been a little bit slow to adapt options, but we are beginning to see that change. In fact, just this month, we crossed 7 billion in terms of open interest across our Bitcoin and Ether options products, and we're beginning to see greater volume as well, an indication that now institutions are moving beyond just futures, also now moving into more sophisticated strategies involving options. And incidentally, we have options on Solana and XRP, going live October 13th as we continue to see growth for those products.
Certainly very exciting.
I was just going to say, I think it's worth mentioning, touching upon regulation,
Yeah.
and how regulators have provided a lot more clarity in the last, feels like a few years, but actually only been a few months, right? And as that increases, and as the clarity increases, the US is obviously leading charge of this with Genius Act, and then the rest of the world, the UK, Singapore, etc., are joining forces. But then you're going to start seeing traditional money managers able to access more assets than just what's on the regulated exchanges. They can go down further down the list. At the moment, a lot of them have to leverage whatever they can trade and clear in their current prime broker or TradFi broker at Goldman's, JP, etc. But once crypto is not a swear word in your mandate, they can start trading a lot more. So I actually think with the increased clarity led by the US and followed through by the rest of the world, I think we're going to start seeing a lot more activity outside of the majors.
Very good point, actually, to touch on that. So, as you mentioned, the Genius Act in the US, and you've mentioned Singapore too, but is there any other areas that present challenges and also opportunities for the industry?
I'm happy to jump in.
Please do.
Yeah, I mean, in the U.S., it's incredible for folks that come from that market to see the SEC and the CFTC collaborate. That's unprecedented and pretty exciting. Obviously, the Genius Act is a major step forward. Commissioner Pham from the CFTC on this tokenized collateral is very, very important. But I think you're going to start to see equivalents as well. So you have the US and the UK, like you get in traditional markets where the regulatory standards are set the same. And so now on a global basis, that's going to be very important for this. I just spent a week prior to being here in East Asia. And so if you go to Korea, the FSC there has a 4-phase, very descriptive rollout plan. It's likely Samsung and Murray will get the ETFs, and you'll start to see these institutional products. I was in Tokyo, and if you look historically, when the JFSA changes anything on the leverage side, which is happening in derivatives, the market's elastic. Like the small change will drive very large volumes. And so globally, regulation, clarity are coming together, but there's different pockets that are still creating this fragmentation. And I think that equivalence piece will really be one of the final steps to broaden the institutional adoption.
And the Genius Act has been mentioned a couple of times, right? And I think what's been really interesting is when you consider that act, and it's about putting guidelines for stablecoins, but we've seen like tremendous growth in terms of our Ether futures volume as well as Solana futures volume, as those platforms are primarily used to mint stablecoins. And just to put that in perspective, if we look at how much Ether has traded relative to Bitcoin in terms of notional volumes, from January to July, it was probably about 25% or so. In August, Ether represented about 80% of Bitcoin volumes, and there were a handful of days where Ether actually outperformed. And I think that's really a direct result of some of this regulatory clarity that we're seeing. And we're also seeing, in growth as well in these new contracts that we launched recently.
Yeah, I'd say, so my firm, FalconX, we've always operated under the CFTC as a swap dealer. And I think the fact that there is a lot more clarity on how to get to a regulated status in the US has really expanded the playing field for a lot of players. That's obviously a positive thing for startups coming into the space who want to challenge incumbents, but it's also, I guess the flip side of that is if there is a clear path, a lot of people who are operating kind of on the fringes and gray areas do need to come out and register and participate in the regulatory process. So, it's a trade-off. Like the whole industry is becoming much more, suit and tie type of place to work. And, I think a lot of us came from TradFi and we're just acclimating to being back in TradFi effectively, even though we all work at crypto companies. So that's one thing. I think the other thing that's kind of interesting is there's a lot of spillover effects into DeFi world, right? So if you think about the growth of Hyperliquid, even though it's not directly touched on in maybe like the Genius Act or any of the kind of regulatory frameworks thus far, the reason that there is so much volume there, I think, is because regulated firms in the U.S., prop trading firms, high-frequency trading shops are emboldened to basically participate in these venues, it's easier to get through risk and compliance committees to deploy on this, given the just favorable backdrop generally, and the fact that like it's less likely for you to get prosecuted down the line for participating in these things because there's a more kind of forward-thinking approach to innovative platforms.
I just think that what Mike said is super important here. I think the biggest challenge that we have globally is harmonization. Right, as soon as we get harmonization, then I think we'll see a huge exponential increase in activity. I mean, Coinbase has started with trying to do this joint task force with the UK and the US, but it's a long way to go globally.
Can I just keep on that theme? It's less regulatory, but it's, like the post-trade side of things is really important for standardization, and we're just not there as an industry, and we need to focus on this. And what I mean by that is, the post-trade blockchains those platforms need to integrate with TradFi Finance to get these efficiencies. And you literally don't have those things. And what's happening is because tokenized finance is moving and outpacing these integrations, you're getting all this fragmentation. And so we need to come together globally to cooperate and coordinate better integrations, interoperability, operational and regulatory standards. And here's an example. I come from the foreign exchange markets. And so September 17th, I think it's very relevant, September 17th of this year, CLS settled $20 trillion that day. Due to their settlement cycle, which is multilateral, the funding obligations to settle 20 trillion was 100 billion. That's 0.5%. And so you have blockchain that can move us from tenures like settlement in T2 to an instant, but you're not going to get that standardization. And so it's definitely somewhere improving that and working on the counterparty credit risk. But I think it's this global standardization, and maybe it's boring in the back office side, but that is critical for scale in this. And we need to do that now while regulations are coming out. Otherwise, institutions will struggle.
Yeah, very good point. And now if we look at moving ahead, so none of us have a crystal ball. I think if we did, we wouldn't be sitting on stage. We'd be retired on a beach somewhere. But if we look 2 years ahead to institutional adoption and institutions going mainstream, what do we see as a key milestone that's happened? Is it tokenization? Is it RWAs? Is it standardization? What kind of things would you see as being institutions mainstream across crypto?
Yeah, I can start. So I think the biggest trend of the next cycle will be things like tokenized equities, equity perp dexes, prediction markets, basically things tied to the real world on chain. I think it's sort of not just something that will benefit crypto broadly, but it's sort of existential for us as an industry to bring a lot of this risk exposure on chain, because we have seen a lot of like capital leakage from crypto going back to equities and other asset classes, as sort of like the risk premiums in crypto have compressed, right? The asset class has matured a lot. If you want really excess, returns in crypto, it's harder and harder to find. So bringing a lot of that risk back into crypto and allowing like speculators to get access to them on chain and cross margin across all these different asset classes on chain is very important. And yeah, I think the other thing I would highlight is like I think all of these things will drive like achievements that all of us in the industry have tried to work on for decades, right? So like one good example would be reducing the margins in equity financing, kind of like stock loan type desks, right? Which exists in prime brokerages. It's like a high margin business where you take some stock that someone wants to go short and you lend it to them at a high rate. And if you can imagine like a world where tokenized stocks are collateral on Aave, let's say, right? And you can borrow those stocks and you can go short them, and it's very transparent what the margin is between a borrower and a lender. And you can see how much inventory there is at all times. That's something very powerful, and it will definitely compress margins in traditional finance, but it's kind of what we've all been working towards for many years, right, as an industry.
But I also think it's even somewhat simpler than that as well, right? Because I think it's also about having asset managers, for example, pension funds begin to allocate to the space, right? So greater allocation beyond just what we're seeing, for example, with DATs, right? It's the continued, say, expansion of derivatives, regulated derivatives in the space, and sort of that transfer of some of these traditional metrics that have worked in the past and being applied, say, to crypto. And ultimately, I guess the end goal is that a marriage sort of between, TradFi and some of these newer technologies helping to improve, say, settlement times and movement of value long term, right?
Yeah, I agree with that. I think for me, success of the industry in a few years' time will be simply financial infrastructure is upgraded to be incorporated into blockchain, and I think that will solve pretty much everything that everyone's discussed here. Like we'll have essentially a aggregate liquidity pool where you have TradFi assets, crypto assets seamlessly being traded amongst each other. You'll have faster settlement times, which results in capital efficiency, and I think that's the way I would deem success. Rather than just focusing on our asset class, crypto should be an equivalent asset class in an institutional manager's mandate.
Very good point.
Last but not least, again, I guess. Yeah, I mean, I agree with everybody said. I think tokenized equities is probably the biggest one, and being able to have digital transfer agents, because the problem is with that, right? Like that's very important. You can't go on Aave and transfer the ownership to somebody who's not KYC'd. So what's coming out today is effectively, swaps on these things in tokenized format. So there's a long way to go from a regulatory and a securities law that's very clearly defined. But I give a non-crypto kind of thing, right? And there's no reason payroll is every, twice a week twice a month in the U.S. But twice a week would be great. Twice a week in the U.S. and a month and once a month in the U.K., right? And so wouldn't it be interesting? I know my platform pays people hourly on the top of the hour, and so if you move to a world where you can start paying people hourly or daily, what does that do, right? Is that interesting? I mean, maybe it's dangerous. Well, actually, the mortgage that you're paying and the interest that you're accruing on that, you can start to crush down the debt side of these things. And so it's not a crypto comment. It's the technology side of these things. And there's obviously, lots of challenges in doing those things. Maybe ADP is probably going to be after me for saying that. But this is readily available. And I always joke around and say, like anything of value, and that's Ripple's big thing, you're in the internet of value, tokenizing things and shipping that round for good collateral and settlement and finality to trades. We're kind of here, and so is Mike Higgins buying a cappuccino at Starbucks on a Saturday and selling my NVIDIA shares. Now, I'm not sure I want to sell my NVIDIA shares for a cappuccino, but the point being, it's for settlement. It's on a Sunday. Yeah. And you could do that. And so we're not far from this type of advancements, but there's a lot of consideration, and the regulators need to be very careful in doing this.
And it's always fantastic as well to hear examples of potential disruptions on specific use cases, because I think here in crypto we do get super focused on charts, number go up, but when you give reference to real world integrations and crypto as collateral and settlement bases, the opportunities are really endless. We do have 5 minutes left, so I'd like to kind of go around and everyone give one of their highlights for 2025 so far before we round up.
I'll start.
I would love you to start.
We're almost done with the Ripple acquisition. So Hidden Road, is a multi-asset prime clearing business, and funded it with pension fund money, and had to go prove the thesis out. And we took about $500 million and deployed that. And then the change of administration last year in November really, was positive for the crypto side of things. Ripple was a small investor in us, and a pretty organic conversation. And when you look at Ripple's, balance sheet and treasury, that immediately makes it one of the largest balance sheets, not just as a non-bank PB, but amongst tier one banks as well. And so, as Usman clearly classified, macro traders are trading equities, fixed income, foreign exchange, digital assets. There's correlation in all these things, and so being able to truly cross margin and margin finance that is super powerful. And so as we do fixed income today, 10-year on the run treasuries against CME, those will be repos on chain, right? And that world is coming together. And so we're excited to do that. We're one regulator away from approval, and off we go.
Congratulations.
Thank you.
Giovanni, over to you.
For me, this one goes out to Tim McCourt, who's sitting right over there. It's crypto becoming the seventh asset class at CME Group.
Well done.
Yeah, for us, it's a little bit niche, but we tokenized basically a pool of loans that we had on our balance sheet. We're a prime broker, so we finance a lot of hedge funds. They're generally like over-collateralized loans against their trading book. And we tokenized it, and then we allowed people to invest in it and generate yield from that, and also run like looping strategies through things like Morpho. On our own debt, which is very interesting, and of course we're acting as a like a liquidator on that strategy. So it's something where we have a good read on our own the quality of our own underwriting. So we're very happy to like participate and be a market maker for that. So kind of interesting, but we kind of see that as a good test case for how things are going to go in the future.
Sure.
I think as an industry, we have a lot to be proud of in 2025, but especially things like the Genius Act and policy. But that aside, to be a bit more, from my perspective, I think what I'm particularly proud of this year is Coinbase's acquisition of Deribit. It just completes the product suite that we can offer our clients, where now institutional clients can custody, finance, trade, spot, perps, options, all under one roof.
Fantastic. Well, Michael, Giovanni, Joshua, Usman, it's such a pleasure to get your insights. Thank you so much for your time.